Good afternoon, everyone. This is Christian with PerfectStockAlert.com, a 100% free service for smart investors and traders. All we ask in return, please refer a friend. Today we're going to be looking at receivables, also known as accounts receivables, on the balance sheet. As I do in each one of these fundamental analysis tutorial videos, I'll give you the actual definition, and then we'll go on looking at an example and give you a little more insight and show you how to use it when you're analyzing a company's balance sheet. Receivables represent money that is owed to a company by its customers in exchange for goods or services that have been delivered or used, but not yet paid for. Now let's go look at some examples. Here you can find accounts receivables, also known as receivables, on the balance sheet of any publicly traded company. Sometimes they'll not have anything, but there's often going to be that category on the balance sheet that you can actually look at. I'm looking at Yahoo Finance just for this example. Obviously, if you were doing some serious fundamental analysis, you would actually be looking at the company's annual report or their 10K or 10Q. So that's something to keep in mind if you're ever going to dig into one of these. Go after the main source. Don't just go, just because you can get it at Yahoo Finance or Google Finance, something like that. You can get a quick little glance at things, but really dig into the company if you want the actual data that's not going to be susceptible to flaw. Right now, the main thing I want to point out here right off the bat is that it's at the top of the balance sheet under the assets. Under the current asset column, you will find receivables right here, or accounts receivable, or in this particular case, you can see it's titled net receivables. So let me give you a little example what that basically means. Basically, net receivables means that the company has receivables, which is money owed to it by its customers. However, they recognize that not all of those customers are going to actually pay their bills. There will be some customers who will default, and those are known as doubtful accounts. So basically, think of net receivables as the accounts receivable minus doubtful accounts equals net receivables. It's pretty basic, pretty straightforward. It's just showing you the amount that they expect to capture after they have deducted for doubtful accounts. Okay? Again, you will notice that net receivables or accounts receivable, depending on whatever is listed here, is under the current assets. So we know that, being that it's under current assets, this is money that the company expects to receive within 12-month period, 12 months or less. Okay, anything that's under current assets would fall into that category. Now I'm going to start off real simple here, and then I'm going to get a little bit more advanced on you guys. You can watch this video as many times as you need to make sure you get it. The net receivables item, the main thing you're going to, just glancing at the balance sheet, the main thing that I would first take note of is I would be concerned if you had a situation where you had a high net receivable number and very, very low cash or no cash situation there. That would basically tell me that the company could get into its little liquidity issue, basically run out of cash if their customers, for whatever reason, decided that they weren't going to start paying off their debt or something of that nature. If we start to have a problem there, you could start to trip up the company. So that would be something that I'd keep an eye on. Also, you can compare to previous years just the amount and see if you, in this case here, it's about 5 billion versus 5.9 billion. It increased by roughly $1 billion. That's not huge, but if you start to see consistent growth here, you start to argue the same thing as you could argue if you started to see consistent growth here. Maybe the company is expanding their operations, maybe they're making more sales, maybe they're just making more sales that are credit sales or something of that nature. So that's something you can do. But to really get into analyzing one company to the next, what you really need to look at is receivables turnover ratio, and that's something I'm going to show you how to do now. It's a little bit more advanced, so take a deep breath and we'll go into this. It's not all that hard, but just it's new information, so let's get moving. Now, as you can imagine, the faster a company can basically turn its receivables back into liquid cash, the better, right? If the longer an accountant's receivable sits out there, the better the odds are of it becoming a delinquent account. So that's something to think about. The sooner a customer pays its bills, the sooner a company can put the cash in the bank and pay down its debt or start making new products. There's many different things a company can do with cash that it can't do necessarily with accounts receivable. There's also, like I said, a smaller chance of losing money to delinquent accounts. Fortunately, there is a way to calculate the number of days it takes for a business to collect its receivables, and this is something that you're going to want to, just write down and use it again and again. You always want to use this because it will kind of give you a red flag if you start to see a change over one period to the next or several periods where you start to see companies' net receivables taking longer and longer to be turned into cash. That could be a red flag. Also, if a company is taking too long to turn net receivables or receivables into cash, they're actually being inefficient because a company could be using that cash to turn a profit somewhere else, or at least get a small return. In effect, a very long term on their net receivables. Basically, the company's giving the customer 90 days or 180 days to pay off its debt. They're giving them an interest-free loan for that period of time, and that could actually hurt the efficiency of the company in question. So let's get to it. To do this, we're going to need two separate financial statements. We're going to need the balance sheet and then the corresponding time period looking at the income statement. So we're going to get this information right quick for you. Before I do that, I'm going to actually show you, so you can write it down, the actual formula that you're going to need for this. Here is the formula. Receivables turnover ratio equals net credit sales divided by the average accounts receivable. It sounds really complex, but it's not. Let me show you right quick. The first thing the fundamental analyst has to do to get the receivables turnover ratio is, of course, get the income statement for the net credit sales. If you want to get the net credit sales, you have to go to the income statement. But you want to make sure you get it from January 30 time period, because that's the actual information we're looking to glean from here on the balance sheet. So we're also going to be looking at the same time period on our income statement. Now let's go over to the income statement right quick. Okay, here we are on the income statement. At the very top, you will find total revenue right there. That's the top line. In some cases, you'll see that broken down where they'll show you the revenue that was a portion of the revenue, or the total revenue that was cash, and the portion that was the net credit sales, which is what the number we'd actually prefer to find. In this particular example here, you don't have that, and in a lot of cases you won't, especially if you're looking at Yahoo Finance or Google Finance, something like that. So what you can do is just use the total revenue figure, or total sales. It means the same thing. What we're going to do is take this number instead of the net credit sales. The numbers won't be as exact. This will be a much more strict analysis because not all of the sales of this company was actually done on credit. Some of it was cash. So by taking the total revenue, we're not getting an actual as perfect calculation as we would if we had the net credit sales figure. But we don't have that, so we're going to go ahead and just use total revenue. Okay, now that we have the $446.9 billion of total revenue, we need to go back to the balance sheet and get the average accounts receivable. So let's do that right quick. Okay, now that we're back on the balance sheet here, looking at the same time period, we're going to take the average, which means we're going to have to come up with more than one number, right? So net receivables, we'll take this number here and the one before it. We'll add these two together, and then we're going to simply divide them by 2 to get our average. Very, very simple. Okay, so we take the 5.9 billion and we add that to the 5 billion here, and we get roughly $11 billion. Now what we're going to do is take that net credit sales, or in this particular case, because we don't have the net credit sales figure, we're going to take the actual revenue figure, and we're going to divide that by our average accounts receivable. Right? That's obviously 11 billion divided by 2 would be 5.5 billion, right? Okay, so let's do that math. Okay, just to make sure we're on the same page here, we're going to take that total revenue number. We prefer the net credit sales, but when we don't have that available to us, we use the total revenue or total sales when we get this 446 billion. Then we simply divide that by the average, and then it's the average of the net receivables the past 2 periods. We simply add them together, divide by 2. In this case, it gets us 5.5 billion. Then we take this number here and we divide it by this number here, and this tells us that this actually turns over their net receivables 81 times, or 81.07 times in a year, in a 12-month period. And that's a lot. Now remember, this is not as accurate a figure as we could have received had we had the net credit sales to work with, but it's still very effective, so it's important to note this. Now, we're going to take this 81 here and actually break it down so we can actually see how many days does it take before the net receivables turns into cash. To do that, it's pretty easy. We simply take the number of days in a year, 365, and we divide it by this number of times in a year that we actually see receivables turned into cash. In this case, 365 divided by 81.07 tells us that receivables turn into cash 4.5 days every 4.5 days. So it's very, very good. It's not something that you should be concerned with in any way, shape, or form. In this particular, using this particular analysis tool, the main thing to think about is if it has a very long term, like I said, you would have an issue with it being that the company is basically giving a interest-free loan to its customers, and it could be better using their money than just doing that. It's basically the longer that net receivables go on, the more days it takes before they're actually turned into cash, the longer that the company's money is tied up in basically receivables. So it's something to think about whenever you're analyzing companies, and you want to compare them across different companies in the same industry and see, okay, how long does this take this company to actually turn its receivables into cash? And then if you find a company that's really really good, like 4.5 days, compared to another one may have 12 days or something of that nature, well, then you would know the company that was doing their net receivables in 4.5 days was actually more efficient. The last item I'd like to note regarding this particular tool, receivables turnover ratio, not all companies have the same deadlines for their customers. Some companies will be, you got 30 days. Other companies will say you've got 60, and so forth and so on. So you need to really be reading the annual reports for your company to understand how their business operates and what their terms are. For example, if the company says, we give our customers 30 days, and then you were to see that perhaps in your math, checking your receivables turnover ratio, you find that they're actually getting their money in 33 days, then you would know, hey, there may be a problem here. Either the company's being too lackadaisical with their credit standards, or they're starting to run into a little bit of a problem, and maybe the economy's turning down. People are having a hard time meeting their obligations or something of that nature. It's just something that you should be aware of, and now you know. Please take a moment to review our disclaimer. The information provided herein is our opinion only. Under no circumstances do any statements here represent a recommendation to buy or sell securities or make any kind of an investment. You are responsible for your own due diligence. To summarize, we do not provide investment advice, nor do we make any claims or promises that any information here will lead to a profit, loss, or any other result. These videos are for educational purposes only.